And welcome back to the Contrarian Trader. It is Sunday, January the 3rd, 2010. Folks, I hope everybody had a wonderful New Year. Happy New Year to everybody. I hope you have a profitable and healthy New Year as well. Let's get straight to the markets. Got a lot to go over this week. Um, in last week's commentary, I mentioned that we probably see a high for the year on the S&P 500 at 1130. And sure enough, that's exactly where we hit. It was actually 1130.38, slightly above 1130. They pulled back. The last trading day of the year, the market absolutely rolled over. S&P 500 went down 1%, and it sold off into the close, which is significant. Now, going into the new year, I don't know this for a fact, but I just have a hunch what these thugs have planned as we go into the new year, what's in their best interest. Their best interest is to have that bullish sentiment from '09 carried into 2010. Now, my guess is that they are going to sell into the rally, meaning if they do spark a rally with a bunch of upgrades on Monday morning or a bunch of M&A news that excites everybody, gets the stupid money off the stupid bench, and excites those people, they'll start selling into that buying by the small investor, which is classic of how all bull markets come to an end. Okay, so let's keep an eye out for that. Okay, please don't be one of these people that watches CNBC, hears somebody come up from Goldman Sachs, spikes the stock, buys it, and just gets slaughtered. Don't be one of those people, please. Uh, Conviction buy list. Why are you from Goldman Sachs? Why are you privy to that information? You don't have an account with them. Neither do I. I don't have enough money to have an account with them. So please don't fall victim to one of those stunts that CNBC pulls. And let's take a look. I mentioned this last week. The RTH looked extremely vulnerable to a sell-off, and that's exactly what we got last week. Now I showed you, and we'll go back to that now, the weekly chart of the RTH. Take a look at the resistance where we were headed into. This goes back to 2007. This is heavy overhead supply, heavy resistance that we're running into. And look at the volume. That this is the volume is your fuel. If you don't have strong up volume, it's impossible to break through resistance and stay above it. Now look at the up volume that you've seen here. And it's meeting severe resistance. And sure enough, what we saw on the last trading day of the year on the RTH, the retail holders, was that they broke. They broke, went down a little over 9%, and it actually looks as though it broke the rising lower band of the uptrend line. So let's see if there's a continuation of that. If there is, folks, please, I beg of you, buy protective puts or get out of the RTAs, get out of these retail stocks. I mean, Christmas is over, and it wasn't good. So I don't know what's going to keep them going, buoy going into the spring. Please, just be careful. The XLF, the financials, they were not able to maintain that rally from the previous week. We're long Goldman Sachs. This is best of breed. It did rally last week, and it found resistance at its declining 50-day moving average. And you see on this candlestick pattern that you have a topping tail. That's a bearish indicator. It's bearish when you have a declining 50-day moving average, and it's bearish when you have a stock sell off as it meets that 50-day moving average. So we're long of the April call options on Goldman Sachs. We're probably going to look to take profits on that and just get out of it. Now, it wasn't meant to be a long-term trade. That was meant to be a hedge on our FAZ position, which is a short fund on the financials. Let's take a look at the chart of U.S. steel. I also mentioned this last week that we had an extremely high, an RSI, which was a little over 85, which is very high. So I mentioned that the Baltic Dry Sea Index, I'm going to come back to this again, but I'm going to show you the chart of the Baltic Dry Sea Index. Normally, you have commodities trade in tandem with the Baltic Dry Sea Index. What is the Baltic Dry Sea Index? It's a measure of goods that are being traded, and primarily China demand-driven trade that goods shipped globally. Now, usually this is based on commodity goods, and China is the real demand hub for these commodities. So if U.S. steel is going up, you would expect that the Baltic Dry Sea Index is going up. That's the way they've traditionally traded. That's broken down. I mentioned the divergence last week. That divergence manifested in a breakdown last week of U.S. steel. And I mentioned that we'll probably get short of U.S. steel. Well, we already have a short trade of the common stock. We did have a loss. We were sitting with a loss on it. I was honest about that. God forbid somebody was to come on CNBC and be honest about their losses. Okay, we still sit with a loss on our trade of U.S. steel on the common stock. But what we did was we wanted to take advantage of the extreme overbought condition of U.S. steel. So what we did is on Monday morning, we watched for a spike in U.S. steel. And they came in on Monday morning, spiked the stock higher. The market makers spiked the stock higher. And look at this. There's no, they opened it up about, I don't know, 60 cents higher on the morning. Now, we waited as long as we could. We watched the RSI, and sure enough, it hit an RSI of 90. I sent out a note to my subscribers, let's buy the January 55 puts on U.S. steel. And sure enough, we got into it at $1.25, and the stock just completely rolled over. The following day, we closed out that position at $1.95. That's a 56% profit on U.S. steel. It was a great profit. The stock subsequently rallied. We knew, let's not stick around to try to catch the last dollar on here, a profit. We were smart. We knew that they were going to try to come in and rally the stock, which they did, and we got out of that trade with a nice profit. Congratulations on my subscribers who joined in. All right, let's get back to the Baltic Dry Sea Index for a moment, okay? Very critical for my continued call of being bearish of China as we go into 2010. Now, there's a report out, and I was reading this over the weekend. The Chinese Academy of Social Sciences in China. Now, a total of 20% of all SMEs, SME stands for small, medium-sized enterprises, basically small and medium-sized businesses, went bankrupt during the financial crisis, which, as their measure indicated, ended in March of 2009. 20% of all their small and medium-sized businesses went bankrupt. Another 20% were on the verge of bankruptcy. Some, let's say half, have recovered and won't go bankrupt, but another 10% have possibly gone bankrupt or are about to go bankrupt. Now, that's just one report. What really reinforces that report to me is that you had their own, this is the China-controlled Ministry of Technology and Information came out and reported that 75% of all SMEs had in fact gone bankrupt. You double that number easily because they control the numbers over there. This is a communist country. You can't believe the numbers that they're sending out. Now, the other item that also hit them over the holiday was that we're whacking them with tariffs on their exports of steel to the United States. They're getting hit with tariffs from all over the world because they're predatory mercantile practices. Now, the world is in a depression-like mentality at this point, and they can't afford to take it anymore. So that's another wallop that's going to hit China. Secondly, all those factories that are laying dormant over in South China, due to the global demand of their products just evaporating, they closed down thousands of properties, but their banks are refusing to foreclose on those loans. Rather than foreclosing those loans, they're just rolling them over, keeping them on the books because they'd rather avoid saying that they have an increase in loan losses. Where have we seen this before? We saw this in the United States only 2 years ago. We saw this in Japan 20 years ago. This is the worst type of banking. For some reason, these bankers just don't get it. Maybe it's the government telling them don't do it. I don't know. But watch out for China. Okay, please. Also, they came to Copenhagen, and I don't think much of Obama. I think everybody understands that. But one thing about this guy, he's really thin-skinned, and for the most part, they spit in his face over in Copenhagen. You can bet there's more tariffs coming down the pike on them. So please be very, very careful of China. Our trade on China is the FXP, which is the short fund, which it trades inverse of the Zhengzhou 25. Now, that's their version of the Dow Jones Industrial Average, okay? We already went long of this position back here when nobody wanted it. That's what we do as contrarians. When nobody wants a stock or an ETF or whatever, commodity, that's when we want it. That's when you're supposed to buy it. Not when CNBC tells you or brings on some joker to tell you to buy something, okay? We went long it back here. It broke out above this declining downtrend line, pulled back beautifully in light volume. Now we're going to look to start adding more. I'll send out an alert to my subscribers. Please take advantage of our 14-day free trial offer. We're now on Facebook. Sign up with us. We have a link on our homepage. And happy New Year to everybody, and I'll speak to you soon. Bye-bye.